All right. Good afternoon, traders. Some of you, good afternoon again. If you were just in the trading room as we were discussing market conditions and what we see, what we think is going to happen here in the market. But for those of you who I didn't see, good afternoon and welcome out to the TradeSpoon Active Investor Workshop Series. My name is Scott Beck. I am the head trading coach here at TradeSpoon, and today we are going to be discussing an option strategy. Well, actually, strategies. I threw that in, right? The title was protective puts in your IRA. Really, protective puts anywhere. These strategies apply anywhere. We're more likely to be implementing them in the IRA because we tend to have longer term holdings in there. Longer term holdings and whatnot, and so we will talk about that. And in fact, even as I was just thinking about this, obviously we look at it as a strategy to protect stock holdings, right? If I own a couple hundred shares, I could buy some contracts to give myself buy some put contracts. We'll talk about what that is here in a minute. Buy some put contracts as insurance, right? That if the stock value drops, the value of the puts goes up, and it's offsetting, especially if it's a long-term holding that I expect will ultimately come back and then some, so I can book some short-term profits to offset unrealized losses that hopefully disappear. So that's the thought process. Now, we have other strategies that we can build. So we're also going to talk about collars today. If you've ever heard of a collar, right? And that is a strategy that we leverage the equity in the stock to produce income and use the income to buy those puts. That's a collar. So a collar is a protective put. It's just there is a starting trade, which is selling of a call, in order to finance that put. And I think we'll even throw a little piece in there about overall market hedging, because here's the thing. This strategy of buying puts, of selling calls to buy puts, if you're buying puts, it's because you own the underlying stock. It doesn't have to be 100 shares, right? If I own 50 shares, I can hedge it with one contract. I know it controls 100, but it might not behave like 100. If I'm doing collars, I do need at least 100 shares, and I need increments of 100 shares, because if I'm going to sell contracts to pay for those puts, I've got to have 100 shares per. But the SPY strategy, the S&P 500, if you have 5 or 6 smaller holdings and none of them have enough shares to do that, you may still want to hedge. And the way you're going to do that is by going through the S&P 500. So now, real quickly, I don't have any comments or hellos or anything, so I'm a little nervous. Are you guys seeing me and hearing me? Thank you, Chet. I was like, it's quiet out there. I need interaction. Don't make me feel like I'm on a soapbox. I want to feel like we're interacting here. Ask questions. Talk about your experience, if you've tried it or what's worked or what hasn't. So, hello, Daniel. Good to see you. Thanks for coming. Hello, Mahesh. Good to see you. And again, thank you, Chad. I appreciate it. So yeah, please, if you've never come before, we like to keep an interactive environment. Be constructive. Ask questions. Give comments. Whatever you feel inspired to do. My name is Scott Beck. I'm the head trading coach here at TradeSpoon. I have been trading for actually going on about 23 years now. Started right at the tail end of the tech bubble in the late 90s, 99. I've been coaching for actually almost 19 years. So there we go. The student awaited. Oh, thank you, Cecil. I will do my best. That's a little bit about me. I need to remind you, and on these classes, I go through these very specifically. We kind of gloss over them in the trading room. Remember that trading in options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. TradeSpoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team of TradeSpoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, TradeSpoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block and Money Block of FINRA and SIPC member broker-dealer firm. TradeSpoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay, now, the way I've been doing these lately, I really am coming at this without slides. I don't have slides. I just roll up our sleeves. Let's dive in and get a little dirty with it. I'm just going to find a stock as our example. You can see there's a lot of choppiness, obviously, in our market recently. I'd want to find something that actually hasn't already fallen, and unfortunately, a lot of the ABBV, okay, that's not bad. A lot of things are already down. BX coming back. Like to see the financials coming back. We'd like to see technology participate in that as well. Boy, the VIX really shed it right at the end. So things look like they're trying to pick up a little bit. Ooh, look at that. Lululemon's getting beat up. Peloton beat up. AMD beat up. A lot of things have already kind of gotten hit. So for some of these things, it would have been prudent to have already insured if you had these. So we're gonna, Procter and Gamble, that might be one. You can see nice, strong defensive stock. Pepsi, another defensive stock. A lot of defensive things look pretty good. Let's do Procter and Gamble. That's not bad. I'm gonna go in and I'm gonna simulate as if I bought. I'm gonna say back here. Back on July 1st at 135. That's going to be my basis. So I'm going to add 200 shares. Give it a little more room. I'm going to add 200 shares at a cost basis of $135.25. That's my basis. Okay. So where we are now, I'd be up $5,000. Nice trade, right? I got in at a good time. Things had looked like they were going to break out of this consolidation. And we jumped in, we rode it, and we're sitting on it. And we're now thinking, hey, I've got a good gain. Can I help with some handholding and trying to find good long-term stocks to apply? Well, see, that's the thing is we don't want to collar them until they're good. So it's still the same thing. What would be the quality we're looking for buying stocks? Trying to catch things that are coming early out of a reversal process. I would say, in growth sectors. So like financials right now, you might be thinking about it. Technology right now, you might be thinking about it. If you look at, so let me show you, for those of you who are not as familiar with TradeSpoon, one of the tools we have here is this research. And this shows you a representation of in this case, the SPY, so the S&P 500. And it's showing us how does it, over 25 years, it's this green line, how does this stock tend to behave over a 25-year period of time? And you can see that we're right here around the beginning of February. Well, if you've ever heard sell in May and go away, here's why. because we tend to get this 2-month period of time from May and June. Then we get one little bump, and then we go sideways for another 2.5 months. That's the summer. Well, February through April and October through December tend to be some of the best growth months, historically speaking. Let's see if that's the case for P&G or Procter and Gamble. So you can see Procter and Gamble tends to be very tepid early and very bullish late, July through December. And if you're looking at this tool like, man, I didn't know about this tool, right? It's a great tool to just kind of get some long-term perspective on how a stock has a tendency to behave. Remember, this is over a 25-year period of time. The past 25 years. So what tends to happen? Well, we have a tendency to maybe go up a little, down a little, but if you're concerned about the market dropping, let's say you're thinking, I'm worried that this is going to drop back to 145. Okay, so what can we do? Now, I'm going to go into singles. First and foremost, if you're ever going to hedge, you're not thinking, oh, I'm going to put a hedge on through, December or January of next year. If you do something like that, it's just almost impossible to make money. It's just if you go out, January, if you go out a year and you buy an at the money option, you're paying literally 8% of the stock to protect it, right? So if the stock had a 16% year, it's a pretty good year, right? For a holding, 16%. I mean, as a trader, you would obviously try to maximize, but if you're buying stock and they're growing, but if you lost 8% of yours because you bought this long-term option to protect it, it's not that helpful. Hedges should come, in times of need. So let's pause for a second and talk about times of need. And so I'm gonna divert our presentation a little bit towards not just the stocks you're in, but what if you have 8 holdings of 25 shares? You don't even have 50 shares of any one stock, but you still want to hedge. You're not going to just pick one of them. Well, you pick the market. So in that case, the SPY, right? Am I a little bit concerned about the SPY dropping? Yeah, a little bit. You can see that we've tested new lows that equaled our lows back here in September. The buyers are coming back in, but they're coming back in on decreasing volume. We're kind of bumping up against the underside of some old support. Yeah, there's a bit of concern here. I don't necessarily think we're just going to V up out of this. So we may have another dip down. That would be bearish. I talked about this in the trading room just recently. We may have a minor dip down and then it turns. That would be a little bit more bullish. And then we would have this just keep on running in a V pattern. That would be this move here. I'm leaning more towards the other two, but we'll see what happens. But again, this is if you're worried about, and this would have been a great thing to do right back here. Not necessarily at highs, but on a lower high. What else happened on that lower high around this period of time right here? This is where I believe we should know something happened. So we go look at the VIX as something that will help us to gauge. And you'll notice what happened on the VIX was actually quite powerful. We had a low, and then we had a higher low. If you notice here, we had the same thing, higher low. If you notice here, same thing, higher low. even back here, we had a higher low. So we have over and over. I'm going to draw the rest of these in so you can see one there, one there, one there. Those are the areas. A higher low. What does that tell me? It tells me that the sentiment, and not just the sentiment, but institutional sentiment, is potentially magnified. Now, to be fair, I would say that there was actually one here. So let me go get all of these up in there because they're all valid. And now I'm going to go back to the SPY. So what would those greens represent? Concern. Hey, I've got a little concern. Oh, okay. Well, what are you going to do about it? Well, I don't know. Maybe hedge. Hedge what? Well, if you have a lot of stock, you might buy puts on each individual stock. Now, here's where the collar comes in. If you don't want to have to pay for those, what can you do? Well, you can sell calls. Now, this is only if you own at least 100 shares of each stock that you're thinking about. So in the case of, and I'll go show you this here when I go back to P&G, I have the potential of selling a call, a covered call is what it would be, right? So I would sell a covered call. I can sell 2 contracts against the 200 shares that I own. Then I can use the proceeds from those 2 contracts to buy puts to protect for the downside. Now here's the thing is over time, this is extremely advantageous. We're not just trying to hedge it. So if I buy those puts and then the stock does drop to 135 and then I think it's bottomed out, I'm going to sell the puts. I'm going to be profitable on them. I'm going to hold on to the stock with the hope and the idea that it's going to come back and even exceed where it is now. If I did nothing, people come back all the time. I'm sure you have some stocks or some things that over the years you've held, it dropped, it came back. Okay. But what if you picked up some nice profits from some puts during that time? That would be great. Right? But we don't want to be in the habit of buying insurance that we don't need. Right? That will stunt the growth of your portfolio. You'll be like, oh, I can't seem to get this right. So, timing is a bit of an issue here. We don't want to just always have a hedge on. If the market's rallying and the VIX is de-escalating, then we want to leave it alone. We don't know if that's the case yet. Okay, so let me show you now the SPY. So this is a mechanism. What I'm showing you is a mechanism that will try to help you get in front of. Get in front of what? Well, look what my green lines are showing. That gets me in front of this. And this. Not as big, but it definitely dropped. And this. Now this one here, it almost was going to drop, but then it rallied. Boom, it failed. Okay. Great. We can live with that. And this. And if we went back, I would imagine we would probably see something somewhat similar, even back here. Maybe not. But you can see, when do I want to hedge? I want to hedge before these types of drops. I don't know that one's going to be bigger than the other. That's outside the realm of what I have the capacity to project. But I do know now that if I go back in, I'm going to switch it back to the VIX again. Because part of hedging is knowing when to hedge. You can see they're very clear. Higher lows, higher lows, higher lows. Ooh, I actually don't think there was one back there in February. It just sort of dropped and then rallied, and maybe halfway through, but no, there was nothing there. So, okay, it's not foolproof, but now what I also want you to notice is where do these boxes end? When do I no longer need those puts? And you'll notice that what is a escalation from a higher low is a de-escalation from a lower high. So here and here, oh, here and goodness, I can't draw up there. And this one was a little tougher, I would probably say, right through here. What happens when we see the VIX de-escalate? And it's not just the VIX turning up or down, but remember, it's higher lows or lower highs. That shows a shift. And you'll notice that from those red lines, what do we tend to see? We tend to see bullishness, 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 right? Context matters. What we do matters. What we do is very much dependent upon the institutions. So hopefully you can see that the context matters here. And we don't know yet. We don't know yet where we are in the current. We know that we're still in an elevated environment, right? So, you know, but when would we have wanted to have put on the hedge is way back when that green line first turned green. When we first start seeing the lower high or the higher lows on the VIX, when we see the sentiment escalating. Now, here's what's interesting. Are you ready for this? What causes the VIX to spike? And this is why it's so much relevant to the discussion that we're having. What causes the VIX to spike? Institutions buying puts, right? Institutions do trade options. They don't, for the most part, trade them speculatively the way you and I might, right? They don't buy calls and puts or put on spreads. What do? In fact, if you were ever to read like a prospectus, I started in the industry back at Fidelity, way back when. Fidelity is very big on mutual funds, right? If you've ever read the prospectus of a mutual fund, it talks about what they can and can't do. Where do they invest? What are the criteria? What's the objective? How much cash can they be in at any given time? Can they trade options? And if so, to what end? Well, if they're allowed to buy options, they typically are only index options according to the index that they benchmark against. So a lot of funds benchmark to the S&P 500. So what can they do? If they look at the market and they're like, ooh, it's looking soft. They don't just start selling. They have too much. They'll crash the market potentially. So what do? They hedge. I'm going to buy some puts. Well, when they buy puts, they buy a lot of puts because they're big. And when they buy a lot of puts, guess what the market makers in the options market are doing? They're raising the prices of options. Oh, you're buying puts? Great, raise the price. And you might think, oh, they're only raising it on the puts? No, the way options work, they go simultaneously because if the implied volatility went up on puts but not on calls, it would actually create and does sometimes create what they call arbitrage, which is kind of risk-free trades. There are computer programs out there that are built to find these little discrepancies. And what it does is it sells the put and buys the call, and it just sort of closes the balance and makes a little money and in and out, and they're on their way. So the implied volatility is going up on the calls as well, but the driver of the VIX moving up is institutional fear. That's why they call the VIX a fear index. Because when the institutions get nervous, what do? They can't hide or manipulate the way they can when they trade the stock. When they buy options, they go to another market. And the other market has no vested interest in helping them. So when they buy options, the market maker's like, oh, demand is up, raise the price. They're still buying. Great. I'm still raising the price. And as long as they keep buying options, they keep raising the price. So they create these little waves of momentum within the VIX that allow us to see, are they overall escalating and increasing their hedges? Because here's what I'll tell you. Institutions do not work against themselves, right? They're not hedging and buying stock simultaneously. If they've instituted hedging, they have shut down buying new positions. And they let their cash contributions accumulate. Remember that institutions are getting money every week. Every week you're contributing to your 401k, your 403b, your pension, your IRAs, whatever it may be. And all that money goes to the institutions. Well, not all of it, but a lot of it, right? A lot of that money goes to the institutions. And as they receive that money, they decide, are we buyers or are we holders? Are we hedgers? Are we? So if the VIX is escalating, they're holding and hedging. So they're just sitting on their cash. Great. Okay, us too, right? Us too. They move the market. Why are we trying to clamor into trades if they're going to be holding and waiting? Let's hold and wait. And also possibly hedge, right? So a protective put is literally just buying a put as an insurance policy. So how long do we need that insurance policy for? I want you to consider the old saying that stocks walk up stairs and fall out windows. Our objective is not to sit in a hedged portfolio all the time. Our objective is to start recognizing through better technical analysis if and when the market gets into an extended position where we start to see the institutions get nervous and we say, oh, here's where I would put a hedge on. You can see that it can revert very, very quickly, right? Look back in October, it was down and then boom, 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 was up. And a lot of times, because the institutions are piling up cash and sitting on cash, when they decide things are okay, it tends to pop fairly aggressively out of the consolidation. So we want to be, ready for that. As far as number one, it doesn't make sense to put I'm going to go into a blue color here for just a minute. It doesn't make sense for me to hedge here, watch it drop, and then say, oh, I guess I don't need that hedge. We're fine. I don't want to do that. Yeah, my portfolio is fine by the time it gets back up to there, but my hedge made some good money down here. I want to bank it down here or as much as I can, only to and then maybe a little bit of I get back. So if you're asking, did I hedge here? The answer is yes. And I sold some here and some here, and I'm still holding a little bit, and I'm very close to getting rid of the rest of it. So if you're going to buy protective puts and hedge, you have to know when are you going to take profits. You'll have to know how long are you trading for. When I buy hedges, I usually go out 4, maybe 5 weeks. I'm not buying months worth of options to just sit and bleed every day. I'm buying them because I need them for the short term, and as soon as I don't need them anymore, I'm getting out, right? I'm buying them because I think I need them, and when they've achieved some of their objective, I'll take some profits, right? I'll sell a little bit, then I'll sell a little bit more, and then I'll hold some just in case things drop again. And if they drop again and I have another higher low on the VIX, I'll actually add some more hedges. So when we talk about buying protective puts, it's not like, oh, did you know you can buy puts to protect? Yeah, you can. Should you? Not always. When it makes sense, we hedge. If it's bullish, don't sacrifice gains needlessly. Make sure there's a valid reason as to why. So yeah. Now, if you have an individual stock, this is what we've been doing here is really market specific, right? The VIX is very much a market indicator. The SPY is a representation of the market. So now, what can I do? Let's go back. Let me know if you have any questions. I'm about to draw this, or I'm about to erase this beautiful drawing. Oh, it's magnificent. It's a work of art. I should take a digital picture and then create an NFT of it and then sell it on the digital marketplace. Yeah, no? It's gone quiet in here. Are you mesmerized or have I put you to sleep? uh, when I do individual coaching, I like to tell people a quote that I came across early in my trading that says, "The blade of grass who doesn't bow before the lawnmower gets his head cut off." So, that's us. We're blades of grass. This is a blade of grass club meeting. The market is the lawnmower. So, do I just want to always have insurance? No, but if I'm recognizing what the lawnmower is doing, who's pushing it, how high the blade is set, how much gas it has, which way it's going, then I'm much better equipped to say, hey, you know what? This is a good time to put some protection on versus a time to say, hey, let's stand up and get some sun and grow, right? Okay, so let me know if you have any questions about that. Now, what is the VIX telling me right now? Well, right now, if the VIX were to turn around from where it is, so tomorrow it stalls, whoop, and then the next day it turns and it starts to go up because the market starts to go down. Well, that's a low, that's a higher low, and that's a higher low, escalating. So I would hedge that, and I would hedge that, right? I would hedge it in the hopes that I have to abandon those hedges pretty quickly. That we go up and we maybe get here and we start to slow down, and then all of a sudden we turn around and we go the other way. And now what do I have? Now I have a high, lower high. And that would actually be the sign for me to say I'm getting rid of my hedges, and I'm now looking for the de-escalation. And that's it. That's I'm using the VIX as a gauge, as a guide to understand market sentiment and whether or not now is a prudent time. Now, I can hedge by buying puts on the stocks that I own individually, or buying puts on the SPY. What else do I like about the SPY? Let me show you. If you look, I've got lots of expiration. So if I want to go 5 or 4 weeks out and say I'm going to go out to the 11th, great, I've got the 11th. If I go a little further, a little shorter, I can say I want 31 days. Great, I go to March 4th. How's the open interest and the spreads look? Open interest is already in the hundreds, if not thousands. The spreads tend to be, now right now it's widened a little and it's still only 6 cents. 6 cents here, 6 cents there, 5 cents there, right? The spreads are very narrow, which means it's efficient, and I'm able to get the trade on, take the trade off without worrying about too much slippage overall. Okay, let's go back to PG though. If I am, so that's market based. But if I'm just hedging this, right? The first thing is I'm not trying to delta match. I'm not trying to take my delta too far down, right? So I'm probably, if I'm going to hedge this thing, going to buy something that is a little bit out of the money. Maybe I go out to the 155s. And I go out for about 30 days, just in case. And I'm only going to do probably a couple of contracts. Now you'll notice that at 2 contracts, my delta is only minus 57. So that's not that much. Let me show you what happens here on this risk profile. If I don't have these puts on, my risk profile is a straight line. Market goes up, I make money. Market goes down, I lose money. If I lock this in, you'll notice now I'm still potentially giving back some gains. But I will lock in. I will keep at least 3,600 of the 4,800 I've made. So that sort of just locks it in, and I make money. Now you'll notice if this drops to 145 like we thought, I have the ability to make somewhere between $1,500 and $2,000 on the trade. Then I basically hope that the trade comes back and gets where it was, right? That's it. That's the strategy. Now, if I wanted more protection, I could get an extra contract because these are out of the money. It's going to cost me a little more, but it's going to give me more downside protection, right? So it looks a little something like this. Now that turns into more of a potentially bearish position, where if it drops all the way back to 135, I actually start making money again and because I have a little bit more. That's an imbalanced protective put. Or the third thing that I can do, and this is the collar. So this is going to cost $1.66. If I go back in, I can look at selling an out of the money call, and I can probably sell that for $115. And I could probably buy this for $160. So it's not quite balanced, but essentially what I'm doing is I'm leveraging the fact that I own the stock, and I'm selling a covered call, right? This is a covered call. It actually still gives the stock an extra $5 of upside potential. If I was convinced, I could actually sell an at the money call to buy an out of the money put. And something looks wrong here. Oh, I got to buy the put. I'm like, wait a second. That looks like it's still only dropping. So here what happens is you lock the gain. If I do this collar, I'm only paying 45 cents for these contracts, right? Because I'm selling calls to buy puts. Actually, this would look more like this. So I lock in my potential right here at the level it's at. I sell for $3 and I buy for $160. So I actually would pocket $280 in profits, and then I would have my stock locked in at 155. So just buying the put, that is protective. That's a protective put. Now people talk about a married put. I mean, if you own the stock and you buy a put on it, it's a married put. It's just the same thing. It's a protective put. Selling a covered call to buy a put, that is a collar. You've collared the strategy so that you're minimizing the downside drawdown, but you're sacrificing the upside potential to do so. Same thing. If you're going to keep owning the stock, eventually you're going to want to take profit on that collar, right? Which means that you sold the calls, they're going to expire worthless. You bought the puts, they've got profit. You sell that and you lock that profit in and you still own the stock. And then you look for the stock to recover. That's the strategy. So protective puts, you can buy protective puts against the stocks you own, especially if you're owning them in increments of 100 or more. If you don't own in increments of 100 or more, or you're not interested in buying individual puts against every stock, you can buy puts against the S&P as a whole. You cannot collar the S&P because you do not own the S&P. If you owned S&P 500, if SPY stock, then you potentially could. But again, if you're using puts on the S&P 500, it's because you're trying to broadly protect your portfolio. And you don't want to have to go through each individual position. So there we go. Got on late, so I assume I know Google had big earnings. Let's see. I actually haven't looked at any of the earnings. Yeah, I mean, Google, they need it, right? So we were at 2750. Now we're about, so we're up about what, 220 points? Yeah, that's pretty good. Thank you, Chet. I appreciate that. Starbucks missed. They're down. They're down at 4%, almost 5% on after hours. What about AMD? AMD had a pretty good one. They're up 12 points, so they're up about 8%. So yeah, it definitely looks like the bull run is likely to continue tomorrow, motivated by motivated by the NASDAQ, which has been lagging. So think about that, right? Over the last 6 weeks, the technology sector has been one of the worst performing. But we've seen a little bit of a shift in the tug of war from buyers to sellers in financials. We're asking to see if we're going to see it from technology. If we're gonna have a bull run this spring, February, March, April, we need financials and tech in place. These earnings are certainly helpful. So a 20-to-1 split on Google. Oh, so they want to bring their price back down, huh? Very interesting. I actually think that's a good thing, right? Psychologically, I think that Amazon would benefit from a 10-to-1, 20-to-1 split. I just don't think people are inclined, even though you can, to buy Tesla probably. For me, the sweet spot's under 300, man. It's like when it starts getting up in those 800, 1,000, and then thousands, it just, I think psychologically it loses something in there. So, do I ever get put or do I sell before it happens? On these hedges, yeah. Remember, it can't get put to me because I own the put. So as the buyer of the put, I have the rights. If I sell the put, I have the obligation. So the only time there would be a something getting put is to somebody else. If I stay in the trade until expiration and the puts are in the money, they will exercise those puts. So if you own stock, they will exercise it, and then they will force someone to buy your stock at a certain price. But the answer is no, I don't want that to happen. The whole reason we're doing this is because we're looking to stay into our long-term trades and sustain through it, but look to book some profits through these short-term hedging activities. Good question. So there it is. Buying puts against stocks we own makes them married puts. Buying puts in general or buying market-based puts against our portfolio is just a general hedge. Selling calls to finance those puts, that's a collar. Those are the protective strategies. What do I know? I know I don't want to sit and protect all the time because it's just going to impede my ability to grow my account. I want to hedge when it makes sense to hedge. When is that? When institutional sentiment is escalating, I want to hedge. So I look for higher lows on the VIX. I look for that to be escalating. And when they no longer need it, when they start to feel better and they start to unencumber themselves of those puts, and we see the lower high, same thing for me. Let's make sure we've booked some gains. Let's get rid of the rest of them, and then go back into bullish mode. Walk upstairs, fall out windows. I want to try to have insurance in place for the fall out the window, but I don't want to sit and hang on to it as we start walking up the stairs again. So my DWAC was up big, so cashed in half for 100% gain. Now ride for free to see if it goes back, and eventually breaks its since. Well, okay. Yeah. I mean, you could look to hedge this. You can see the implied volatility is high. It's a volatile stock, so it's going to go a little bit up, a little bit down. But yeah, your tactics of taking profits, that makes sense. I like it. It's a good tactic. If you own increments of 100, you could sell expensive calls to buy puts in order to put a collar on something like that. Most definitely. So certainly a strategy that would work. So okay. Any other questions about these strategies? I'm a big believer. In fact, I would say that if you don't have a strong risk management section in your trading plan, you should. It should incorporate things like position sizing, portfolio heat, number of trades at any given time. It should incorporate how your risk levels are going to change or fluctuate according to market conditions. Right? but it should also incorporate hedging. And what are you going to do to protect against the longer term positions? So hedging is a vital part of a trader's toolbox. Make sure you sharpen the saw and really get that thing working as best you can. All right. Well, awesome. This was great. I had a lot of fun. I wasn't even sure what we were talking about today, but this was a good one. So it's appropriate. Hedging is an appropriate topic at any given time. So there you go. All right. Have a wonderful day. I appreciate you guys coming out and hanging out with me. I'll be back in 2 weeks. If this is all you come to, come back, hang out again. I'll be back in 2 weeks for another presentation. I have no idea what it's about, but it'll be awesome. So come. Those of you in the trading rooms, I'll see you tomorrow or at least sometime this week. Those of you who are just kind of looking at what we do here at TradeSpoon, well, we try to provide great tools. We try to provide good education and analysis. Over and over and over again, right? More of the same. So if you were thinking about it, join us in the subscribe and join us in the trading rooms and see what we have to offer. Other than that, it's good to see you. Like I said, have a great rest of your day, great rest of your week, and as always, happy trading.